Welcome to this explainer. Today, we're putting modern balance sheets through the ultimate diagnostic test. We're going to take a deep, X-ray look at a company's true financial health by decoding IFRS 7, Financial Instruments Disclosures.
So think about this for a second. How do you actually measure the hidden risks in a company's financial instruments? Because on the surface, a balance sheet can tell a very neat, clean story. But the underlying financial instruments, things like complex derivatives, layered loans, and massive hedging contracts, can hold an incredible amount of mystery and hidden exposure. IFRS 7 is basically the regulatory X-ray machine built specifically to expose these risks, making absolutely sure that investors and stakeholders aren't caught off guard.
Okay, let's dive into this. Here is our roadmap. First, we'll cover the objective of IFRS 7. Next, evaluating position and performance. Then, the big three: credit, liquidity, and market risks. Fourth, hedging and asset transfers. And finally, the IFRS 9 transition.
Let's jump right into Part 1, the objective of IFRS 7, revealing the framework.
To really understand the power of this standard, it's kind of fascinating to see how it evolved right alongside the explosive complexity of modern markets. Back in 1990, the standard was IAS 30, but as global finance became exponentially more complex, that old standard just wasn't cutting it. So by 2005, IFRS 7 was issued, completely replacing IAS 30. And since then, we've seen these really targeted major updates: enhanced fair value and liquidity risk reporting in 2009, tighter rules for netting arrangements in 2011, and most recently, the interest rate benchmark reform Phase 2 in 2020. This timeline really shows us a framework that's constantly running to keep up with complex market realities.
At its very core, IFRS 7 has this really clear dual-pillar mandate. First off, it requires entities to provide information that lets users evaluate the actual significance of financial instruments for their financial position and performance. In plain terms, how much do these specific instruments actually matter to the company's bottom line? Second, it demands absolute transparency on risk. Entities have to disclose the exact nature and extent of the risks they face both during and at the end of the reporting period. And crucially, they have to explicitly lay out exactly how management handles those specific risks.
Moving on to Section 2, evaluating position and performance. Let's look at the anatomy of the balance sheet.
When a company reports its financial assets and liabilities, they can't just throw them all into one big, ambiguous bucket and call it a day. IFRS 7 dictates that they must be grouped into rigid categories. Instruments have to be classified as either measured at fair value through profit or loss, at amortized cost, or at fair value through other comprehensive income. And this structure is absolutely vital. Why? Because it directly dictates how these instruments are valued on the balance sheet and exactly how shifts in their value hit the company's reported earnings.
A massive part of evaluating a company's true position involves looking at offsetting, or what we often call netting. IFRS 7 demands super strict disclosures here, specifically to prevent companies from artificially shrinking their balance sheets to mask their true financial footprint. Entities have to show the gross amounts of recognized assets and liabilities, the actual amounts they've set off, and the net amounts finally presented. They even need to disclose amounts subject to a master netting arrangement that aren't set off. It's all about making sure the full, unvarnished scale of a company's exposure is out in the open for us to see. But knowing what a company currently holds is only half the battle. We also need to know what happens when things start to go wrong.
Which brings us to Section 3, credit, liquidity, and market risks, preparing for the what-ifs.
So, to give users a truly complete picture, IFRS 7 legally requires both a narrative and hard data. On one side, we have qualitative disclosures. This is the story. What are the exposures? How do they even arise? What are the company's internal objectives and policies for managing them? Then, on the flip side, we have quantitative disclosures. This is the hard data. It requires summary data based on exactly what is provided internally to key management, and it highlights specific concentrations of risk. Having both means we don't just get numbers completely stripped of context, and we don't get a nice story without the evidence to back it up. Let's look at the first of the big three: credit risk. The standard formally defines this as the risk that one party causes a financial loss for the other by failing to discharge an obligation. Put simply, what happens to the entire balance sheet if a counterparty just decides not to pay up? To actually manage and report this, companies use a highly complex expected credit loss model. And let me tell you, the required disclosures around this are intense. An entity must disclose how it determines if there's been a significant increase in credit risk since initial recognition. It must clearly establish its own definition of what constitutes a default. It needs to show how it determines if assets are already credit impaired and lay out its specific write-off policies. All of this ensures companies aren't just scrambling and reacting when defaults happen, but are actively predicting and provisioning for expected losses based on forward-looking strategic data.
Next up is liquidity risk. This is defined as the risk that an entity will encounter difficulty in meeting obligations associated with financial liabilities that are settled by delivering cash or another financial asset. Essentially, we're talking about the risk of a severe cash crunch. A company might look incredibly profitable on paper, but if it doesn't have the liquid assets on hand to actually pay its immediate bills, it's in deep, deep trouble.
To give investors an early warning system for these potential cash crunches, IFRS 7 demands a specific maturity analysis. Entities must explicitly disclose the remaining contractual maturities for both non-derivative and derivative financial liabilities. This forces the company to line up exactly when their debts are coming due. That allows anyone reading the statements to judge whether the company has its cash flow timing matched up appropriately to survive both the short and the long term.
The third major category here is market risk. This is all about the big picture volatility, the risk that fair value or future cash flows will fluctuate because of changing market prices. We're talking currency risk, interest rate risk, those massive macroeconomic forces that can alter a balance sheet literally overnight without the company changing a single operational thing internally.
Because market risk is largely driven by completely external factors, IFRS 7 mandates a sensitivity analysis. It requires entities to show exactly how profit or loss and equity would have been affected by reasonably possible changes in the relevant risk variables. It forces companies to stress test their resilience and literally show their work. If interest rates spike next quarter or a major foreign currency suddenly collapses, what exactly happens to the bottom line? The sensitivity analysis answers that question directly.
Let's move to Section 4, hedging and asset transfers, managing those exposures.
As we know, companies often use hedging to protect themselves against all that market volatility. But if they choose to apply hedge accounting, they must definitively prove that their strategies actually work. The disclosures must clearly outline the risk management strategy and exactly how it's applied. They have to explain how hedging activities affect the amount, the timing, and the uncertainty of future cash flows. And finally, they must show the specific effect of hedge accounting on the statement of financial position and performance. This is crucial because it stops companies from hiding massive, speculative bets under the safe, boring guise of risk management. Now, what's really interesting here is how the standard decodes the highly technical conditions around transferring financial assets, like, say, when a bank bundles up and sells off a ton of mortgages. If those assets are not derecognized in their entirety, meaning the company still holds on to some underlying risk, they must disclose the nature of those assets, the risks, and the associated liabilities. But here's the kicker. Even if they are completely derecognized, yet the entity still has some continuing involvement, they still have to disclose the carrying amount, fair value, their maximum exposure to loss, and a maturity analysis. The big takeaway here? You can't just pass off your assets and pretend the risk completely vanished if you still have skin in the game.
And that brings us to Section 5, the IFRS 9 transition, the evolution of reporting.
Whenever a company transitions from the old standard IAS 39 to the newer framework of IFRS 9, IFRS 7 requires very specific initial application disclosures. Users need to see the original measurement category and the carrying amount under the old rules, mapped directly to the new measurement category and carrying amount under IFRS 9. The entity must also provide qualitative information on exactly why these classification changes happened. This is super important because it ensures investors understand whether a sudden shift in financial health is due to actual business performance or if it's simply a shift in the accounting rules.
And this brings up a fundamental concept we really need to keep in mind. IFRS 7 must always be read in the context of its primary objective and the broader conceptual framework. It doesn't just float out there in a vacuum. It relies entirely on a structured, interconnected ecosystem of standards to actually guarantee global transparency. Which leads us to a final, somewhat provocative thought to wrap things up. IFRS 7 provides us with an incredible, powerful tool to view a company's financial instruments and all those hidden exposures. But does mere compliance with the letter of IFRS 7 guarantee total transparency? Or does the true picture of a company's risk ultimately still depend on the judgment, the estimates, and the sheer honesty of its management? The standard definitely gives us the absolute best tools available today. But interpreting the true underlying health of a business, that remains an art just as much as it is a science. Thank you so much for joining me for this explainer. I hope this helps you look at the next balance sheet you encounter with a whole new, structured perspective.